As you go about your planning for 31 December reporting period, we have some key questions for you. Have you considered the new accounting standards that are effective for the first time this year end and this half year? So the key changes are the new standards on revenue recognition and financial instruments. A word of caution though, in the international regulators in Europe and the US have made some recent observations about their expectations around the disclosures of these new standards. And they have said that even if the impact of these new standards on recognition and measurement are not significant, they do expect transparent and clear disclosures about the accounting policies applied and disclosures that meet the objectives of this new standard. And so while these are observations from international regulators, given how closely our Australian regulator ASIC works with the international counterparts, we do expect that ASIC's focus this 31 December year end will also be on these new accounting standards. Are you in ASIC's spotlight for the accounting for these transactions and how they're treated for tax purposes? The recent results from ASIC's financial statement surveillance program has revealed that for the first time in a long time, that their comments on revenue recognition have exceeded those on asset and impairment, and that they are increasingly interested in how transactions are treated in tax returns. And also in this current climate of tax transparency and increased ATO action, have you considered the possible impacts of the new interpretation, this is IFRIC 23, on uncertain tax provisions? It's entirely possible that your provisions for uncertain tax will be recognised earlier under this new interpretation than is currently the case. Do you have any potentially onerous revenue contracts where you're trying to bridge the gap between the accounting under AASB 15, the new revenue standard, and the general provisions standard? Unlike previous revenue standards, AASB 15 does not have any guidance on how to account for potentially onerous revenue contracts. And this has raised some practice issues. For example, do you need committed volumes as per the definition of a contract under AASB 15 when you're doing your onerous contract provision analysis? We have a worked example in our recent webinar on 31 December reporting considerations that I encourage you to look at if this is an issue that is relevant to you. Also, have you had any debt arrangements where you have modified the terms and conditions? It's possible that with AASB 9, the new financial instrument standard, that even non-substantial debt modifications could result in immediate gain or loss recognition. And this could have an opening retained earnings impact on adoption of AASB 9. Once again, our webinar on 31 December reporting considerations takes you through an example. And we do encourage you to have a look at this because we are finding that this issue could be a sleeper issue for many companies. So those are our tips for this 31 December reporting season. Good luck. Thank you.